Retirement is often portrayed as a dream come true, a wondrous state of enlightenment. But for far too many, it is often a stressful and confusing time, and many times this is due to the management of their wealth. Here are the most common mistakes that investors make in relation to their retirement planning. Welcome to another episode of Money Matters. One of the first and perhaps most basic of mistakes that investors make is their approach to investing in the financial markets. Too many investors approach it as if it were a bet on a horse or a gamble at a casino. They rely on hearsay or the news headline of the day to influence their investment choices. Often they have a rather concentrated pick of stocks and take on far more risk than they need to for a retirement portfolio. It has been proven that a well-diversified portfolio that follows the global markets will deliver a high single-digit and even double-digit annual returns. There is simply no need for an overly concentrated portfolio, especially when most of the time nearly all investors get it wrong. Along the same theme, investors' second mistake is to try to time the market. Once again, hot news and following momentum lead investors to buy high and sell low, the opposite of what they were hoping to achieve. Corrections are sentiment-driven market drops that are sudden but brief and can be quite large, whilst bear markets are fundamentally driven, sustained and large market drops. Investors often fall foul of both of these drops in the market. Investors are fearful of short-term losses more so than they get pleasure than making gains. Myopic loss aversion means that investors react to sudden market drops and often sell near the bottom only to miss out on the rebound that ensues. At JS Wealth, we firmly believe that it is not your timing of the market, but your time in the market that leads to your investment success. I know that a lot of investors won't believe me. Some still think that they can time the market. The best way to find out is to run two portfolios side by side. In one, you have an index tracker tracking the S&P 500 index, which from January 1988 to 10th November 2020 has delivered an annualized return of 10.7%. In another, manage your own portfolio of stocks and see how you compare. While some investors go chasing high returns by timing the market, there are others who are far more cautious. Maybe they used to be one of those stock pickers trying to time the market and got their fingers burned. Whatever the case, they are fearful of the volatility inherent in financial markets. This is especially true if you follow the daily market updates showing you daily market swings of a few percent, meaning that a 3% drop today lost you $300,000 of your $10 million portfolio in just that one day. However, investors must consider other risks relevant to retirement planning. One such risk is shortfall risk, which means that not by taking enough market risk, you end up falling short of your retirement goals. Remember that retirement planning is often a long-term plan, and with time on your side, you can ride out the short-term peaks and troughs in the market and benefit from the long-term gains. If an investor's portfolio was only making 4% per annum due to their cautious investment picks, and another was making a more reasonable 9% per annum, $1 million invested 20 years ago would be $6.05 million versus only $2.23 million, which is a loss of $3.82 million and a drop of 63.2%. Start to define that loss in terms of one's retirement and you can see a clear picture of the difference in retirement. Another risk is inflation risk, which applies particularly to cash hoarders. I often come across many who hoard cash, and whilst in business speak, cash is king, in the investment world, cash is certainly not king, and inflation is the silent and deadly killer of wealth. If someone is holding $20 million in cash in the bank earning 0.2% per annum, and if inflation is running at a reasonable 3% per annum, they are losing $560,000 each and every year in real terms. They are literally losing buying power. That's a brand new Tesla every year. Most investors invest and hope for the best when it comes to retirement. In other words, they let the performance of their investments determine their retirement lifestyle. I don't know about you, but to me, that sounds crazy. Why not do it the other way around? I would suggest investors planning for their retirement to take a little time out of their busy lives, grab a glass of their favorite beverage, a pen and paper, and jot down all the things you would like to do in retirement. What would your retirement lifestyle look like? By visualizing our aspirational retirement lifestyle, we can begin to quantify how much of an income we will need month to month to fund our ideal lifestyle. We may also want to set a minimum target too. How much monthly income do we not want to go below? By understanding how much we have, how much we earn, how much we want, and how much time we have, we can begin to understand the run rate we must achieve. Because at the end of the day, three main factors determine our investment outcome: how much we put in, how much return we get, and how long we are invested for. In short, it's always crucial to set the destination before we set off on a journey. Most investors often think of their investment time horizon ending on their retirement date. This is also compounded by incorrect information with financial products out in the market. For example, lifestyle funds, which includes the MPF default investment strategy, supposedly provide an optimal asset allocation, which means a blend of different asset classes such as stocks, bonds, and cash, depending on the horizon leading up to retirement. These funds start with a growth strategy with a majority weighting towards stocks in the early years and begins to move into less volatile assets such as bonds and cash as one approaches retirement. In nearly all cases, this is wrong. Why? Well, for nearly all investors, their retirement pot will still be used to generate an income during their retirement years. Therefore, it makes sense to remain invested during this time. There is no benefit in taking a whole lot out and putting it into the bank for reasons mentioned earlier. It is also unlikely that the retiree will spend the whole lot in one go. So in basic terms, the investor will typically go from a pure growth strategy to one which generates enough income for the retirement years. And this requires generating returns from the financial markets without being overly cautious, as our time horizon is longer than we thought. And more often than not, we need high returns to be able to sustain the retirement lifestyle we desire. No doubt, there are many more mistakes that investors make in their quest to achieve financial freedom. Whilst many of us have been taught to study hard, get good grades, and earn a decent living, few of us have been taught to manage our finances to turn all that hard work into something meaningful at the end of it all. One of the biggest faults in planning for our retirement is apathy, or the lack of taking any action. So this weekend, take an hour out of your busy day, grab your favorite beverage, a pen and a paper, and start visualizing and planning for your dream retirement, and then take action. Thank you for joining me on this episode. Let me know what other topics you would like to hear about in future videos. If you like the video, smash the like button, subscribe, and I'll see you in the next episode of Money Matters.